Dames en heren, goedemorgen, ladies and gentlemen, good morning. Welcome to this edition of LeadersAngle. I would like to especially welcome a number of members of our partner schools here. We have in the audience Professor Michael Frenkel, who is Dean of WHU Orthobeisheim in Germany. Professor Henri Joly of EACP, EAP School of Management in Paris. Madame Brigitte Passiera of Zoetekool Rens. Marie Odile Dominique of Toulouse Business School. And Julie Holstein of Nottingham Trent School in the UK. A special word of welcome to you. Our topic this morning is a panel discussion on the short-term economic future of South Africa. And in the chair we have Professor Andre Roux, who is Director of the Institute for Futures Research, who doesn't need any introduction in this audience. And the members of our panel, Professor Benstedt on my left, who is Director of the Bureau for Economic Research at Stellenbosch University. He holds a doctoral degree in economics from the University of Stellenbosch, and his research focus is on international finance, on macroeconomic policy, and on econometric modeling. He has also studied at the University of Pennsylvania, Wharton School, and he has done consulting for the Department of Finance, for the Committee of Inquiry into Mining Taxation, for GEAR, and for the World Bank. In the center, we have Ms. Nulani King-Conradi, who is Chief Economist and Managing Director of NKC Independent Economists. She holds a BCom Honours from Pretoria University, started a career at Rand Merchant Bank, Asset Management, moved to ABSA Corporate Bank's Treasury Department, and later on in the stockbroking arena at SG Franco Pollard Securities. After that, she started the economics department at PSG Investment Bank. And the third member of the panel is Mr. Johan Rousseau. He holds an MCom degree, cum laude, 12-year experience in financial markets. Started off in the public sector, and he got involved in financial markets later, joined the stockbroker Huysman Stals, later became ABN AMRO Securities, and he was the chief economist and strategist for South Africa. He is rated in the annual Financial Mail Analyst ratings and also in Reuters Economist of the Year ratings. At present, he is with Budani Securities in Cape Town. So welcome to everybody, and with that, over to the chairman. Thank you.
Thank you, Johan. Good morning to everybody. I think if we cast our minds back 18 months, a mere 18 months ago, early last year, then it seemed that globally things were fairly healthy, fairly robust, if not overexciting. There were signs of a rising oil price, but we said to ourselves, don't worry too much. In real terms, not that much higher than 30 years before. Food prices showing signs of increasing, but again, don't seem all that serious. America had a number of major deficits, but we've been saying that for more than 30 years. And in any case, we have China in the background, which will sort out all these problems. Locally, pretty much the same kind of approach. Yes, inflation was rising, but don't worry, the Reserve Bank will quickly sort that out by tweaking interest rates. But if we fast forward a few months, about 12 months ago, a year ago, suddenly these things were no longer as comforting as we had thought a few months earlier. The oil price was no longer low in real terms as we had thought. Food prices were accelerating. Yes, and suddenly a new word appeared in our dictionaries, the subprime crisis in America. And before very long, by early this year, these things were no longer just seemingly passing fads. Things seem to have changed rather dramatically. Here too, inflation remained not only stubbornly high, it was rising stubbornly, despite attempts to reduce it. And of course, early this year, we came back from holiday and were confronted by a few electricity problems. And the overall mood certainly changed for the worse within a very short space of time. And today, probably more than any time in the last decade or so, matters economic are suddenly a bit more worrying than we had thought for about a decade. And therefore I think it's very appropriate that we should try to take a look, gaze into our proverbial and imaginary crystal balls, and try to first of all gain a better understanding of what's happening and why it's happening, and perhaps even more importantly and challengingly, try to figure out how these things are going to pan out. Now I think in a typical orthodox way of looking at things, one tends to start off with discussion and analysis of the global economy before narrowing down to our own local economy. So I think we'll follow the same approach. And before we start talking about economies such as the USA in particular, it might be useful to briefly probe the idea, the notion, that world economic affairs or non-American economic affairs are or are not as vulnerable as they used to be to what is happening in the American economy. The idea of delinking or decoupling from the American economy. Put slightly differently, is the American economy as important to the rest of the world as it used to be, or is the rest of the world more immune compared to what it used to be? And maybe we could start with you, Ben. Your thoughts on this matter, the relative importance of the American economy in the modern world?
Yeah, well, Andre, you've posed the questions right, and also the change, I think, in the experience from last year to where we are now. What the world is experiencing to Africa is also to quite some extent, if we come to that experiencing. The idea of decoupling 10 years ago, if America sneezed, the world had a cold. The American economy went into recession, the same was applied to the world economy. But that has certainly changed. Just to give you an indication, last year the developed economies grew at about 2.5%, and the emerging markets at 7.5%. The forecast now, I take JP Morgan forecast, is 1.5% for this year and about 1% for next year, and 6% for the emerging markets. So it appears from that sort of metric that certainly there seems to be some form of the life of its own that's been created for developing economies, emerging markets, particularly China, India, the BRICS, broadly speaking. But we don't believe that the emerging markets are completely immune from what happens in the US. And there's a substantial concern about the play-out of the subprime problem. I think that's probably the biggest international risk also coming through to South Africa. So some decoupling, but certainly not to the extent that China and India and the rest of us will not feel what's been happening in the US.
So America still matters, Melania? Does America still matter to us?
Most certainly. I agree with Ben 100% that there definitely has been a decoupling over the years with the emergence of particularly Asia, but also Africa. Africa being one of the regions after Asia that's been growing extremely strongly. And I think that's another indication that maybe it's because particularly the financial markets and the economies are not as sophisticated as the South African market and some of the other emerging markets, that it's not as affected by particularly the subprime crisis. But yes, there will still be an impact. So it's still the biggest economy in the world. It's not the gap between the US and China in particular is very rapidly diminishing over time. And I don't think it's going to be too long from now before Asia overtakes the US. That's the biggest contributor to world GDP. But for now, there most certainly still is an impact, but it's not nearly to the same extent as it was a decade ago.
Right, well, let's talk about America then. Are they in a recession, Johan?
Well, I would say if not, they're pretty close to that and definitely heading towards that. I would imagine yes, in fact. So, and you know, I don't see it improving in the near term, I'm afraid to say. The lag impact of events over there will sort of have a detrimental impact for quite some time. On the other hand, you know, I do believe they've averted the meltdown scenario. The decisive move by the Fed to cut rates quite drastically, and then also the fiscal support coupled with that, I think probably averted the doomsday scenario. But yeah, tough times ahead, and yeah, probably in recession.
And then what's behind this recession?
Well, an important part is with the consumer with the housing problem. So it's also quite the strong basis for subprime problems. So consumer confidence in the US, which you can measure, I think it's on the lowest like in 28 years. I don't have a graph to show it now. But the consumer is certainly feeling a lot of pain. I believe there was somewhat better news last night in terms of the second quarter growth, which may have some positive indication for some news. But in the beginning of the year, we thought the Americans were definitely going into recession, and strong news on that. And what transpired to the middle of the year is that the European situation sort of worsened relative to the US. So the perceptions on the US aren't quite as negative as it was earlier this year, but there's certainly strong questions about moving into recession.
Andre, can I maybe just add to that? I agree with Johan. I think there are, if not in a recession yet, but probably going to move into it in the next quarter or so. But I think one thing we must remember is in terms of the turnaround, is if you look at history, the US economy, given its sophistication, generally comes out of the crisis very quickly, much quicker than any other economy in the world. So I think markets might not too long from now start to price that in, that yes, we are in a doomsday scenario at present, but the turnaround time is relatively short.
But could this crisis differ from previous ones? Is it different about this one? I mean, people use the word stagflation. Does that make a difference?
Well, the magnitude of the write-downs, about $500 billion, that's staggering. In my view, that's unprecedented. And obviously that will have repercussions throughout that economy, like I said, for quite some time, I believe. And on top of that, we're not sure that, that is it now. There might be more skeletons in the cupboards, which might pop out later. And obviously, that could drop the boat even further. So, and on the other hand, we've experienced the inflation problems over there, like we've experienced all over the world, basically commodity and food price related. And that definitely is the risk, that they might end up in that scenario. But like I said, I personally believe they probably averted that, and they'll pull out of it, without a deep crisis.
So just to add to that, the inflation fear over the last 6 months has really become strong for emerging markets and for currently world inflation according to JP Morgan is 5.2% for the world economy as a whole, which is very substantial. Emerging markets 8 plus, and developed markets 4. And there's real concerns about inflation going forward. And the choices of monetary policy makers had to make in terms of fighting inflation and allowing for a weak economy, and where the choices are going. Right now, it seems that, like in South Africa, perhaps the inflation impact, also with commodity prices looking like it's slowing down, maybe not as critical as it's been 2, 3, 4, 5 months ago. But the bigger concern is how the subprime impact on credit availability in international is going to play out. That's the lingering fear that it may actually take much longer before everything goes through. Johannes mentioned the 500 billion that's been written down. There's talking about another 500 billion that's still coming. Kim Rogoff, the previous IMF economist, earlier this week sort of said there's one big institution, big bank that's going to fail. I mean, that's quite a risky thing to say, someone in his previous position. But apparently there's still quite substantial uncertainty as to how it will play out, even over the long run, the next year or two, a lot longer than that, because we don't know. But we hope it's not going to be that bad.
So given current assumptions and thinking, how long is America split up for? Months, years, quarters? Is there a structural change? Is this a structurally entrenched kind of story? Or is it remain a cyclical one?
Well, my view is that, the remainder of this year, obviously, I think is still going to be a battle. And at best, given the lag effect of the monetary easing, we should be looking to some sort of recovery somewhere around next year. My best guess would be around about the middle of next year. We should see some recovery coming through. But I'm afraid the risks are on the downside. In particular, if we have further financial instability, the repercussions there are quite significant. So I'd be cautiously optimistic that in the middle of next year, we should see some improvement.
No, okay.
I'll take a look at practice. And just from perspective, I mean, we've been in a world economic upswing on sort of unprecedented magnitude since 2001, 6 years, like South Africa. This is, the business cycle hasn't gone away. There are very particular characteristics of that now. We are concerned about structural issues, but in a sense, it's also a normal development. It's not. We shouldn't expect not to have that, given sort of experience that I've had for the past 5-6 years internationally.
The business cycle is alive and well.
Apparently.
I agree with you, and I also think that, and with them, I think we reinforce it next year. I think the critical time is this year. The negative quarters, if we're going to see them, it's going to be this year, maybe still the first quarter of next year. But I think after that, the rebound is there, given the actions taken by the monetary authorities in the US. And given its resilience, it will rebound over time. Depending on whether there's still bad news to come, or the skeletons in the closet, as we referred to in terms of better prices, it could put us back a little bit. But I think during the course of next year, they will start to rebound.
And we move across the pond to Western Europe. What can we say about the economy there? Is that lagging behind America? Is there still to come there?
Well, it certainly appears that, particularly from about the middle of the year in the West, Europe is certainly sort of slowed down. There's talk about recession in a variety of European economies. So the America actually looks a bit better than Europe right now. Things certainly have slowed down noticeably.
And I think it's also important to note the different stages they find themselves at in terms of the monetary cycle. The Americans have got quite decisively. We haven't seen that yet in Europe. And obviously they've opted to a large extent to focus on the inflationary problem and be playing quite tight on their policy. But yeah, so that is, in my view, answer your question, lagging a little bit. And yeah, like you said, downside risk quite a bit.
They are certainly lagging. I think from the inflation perspective, the US, in terms of the levels of inflation, has got a higher level than Europe. And that's why they've been more aggressive in easing monetary policy. On both sides, you probably see unchanged interest rates before the end of the year, but then the US likely to high rates during the course of next year, and Europe would be the opposite. And that might be an explanation of the movements in the dollar against the euro. At present, markets pricing that in as one factor driving the exchange rates.
Well, along the way, obviously, you've all spoken about oil prices, fuel prices, food prices. Where are we there? What's the big story there? What awaits us in terms of, let's take oil prices? Have the days of $40 a barrel gone forever and ever? Are the days of $250 still awaiting us? What's the story there? Almost impossible question to answer. But a few reflections on the oil market today.
Well, I think that's closer to that decline on the still perspective. There's been a lot of talk about whether the oil price has been driven by speculative forces or by demand. It's clear there's been very strong demand growth, particularly from China and elsewhere. And I believe that the commodity cycle, broadly speaking, not just oil, is likely to remain in an upward trend. So sometimes we talk about super cycle. Right now, I think we are looking at a situation where the prices are clearly sort of are subsiding. Right? So some of the statistics sort of on that. But it's been quite a decisive move, I believe. You also see now the reaction of the oil price, in particular sort of geopolitical event, is much more muted now than it was. Gustav is the next big hurricane. The response even to that is not as big as it been. So I think we've seen some very beneficial changes on oil in particular and other commodity prices. And that will feed through into food prices. And that's part of the relative optimism that inflation has driven, particularly from those sources, are likely not to escalate very much from where we are now. So I think the outlook is perhaps better. Our own forecast would be, the oil price next year for $110. Maybe less than that. But $40, I think that's for our fathers that will remember that. But our kids about, they could order $40.
You want some thoughts on commodity prices?
Yeah, look, I should maybe just start off by saying, if you look back at our forecast performance over the past year on the oil price, I'm afraid it's not one we're going to boast about. We certainly got it wrong, and I think most analysts out there, not only here domestically, but also internationally, got it wrong. Be that as it may, since the end of 2001 up to the end of June this year, world commodity prices increased, the Economist Oil Commodities Index, by over 200%. The oil price future over that time increased by 590%. So quite a staggering sort of magnitude of increase there. But the good news, I suppose, is that since June, the end of June, there was quite a significant decline in world commodity prices. If you look at the oil commodities index, the decline was over 12%, and in case of the oil price future, it's close to 20%. So very early days, obviously, but it looks like we've entered some sort of period of moderation in global commodity prices.
And what's needed to sustain that moderation?
Well, firstly, I suppose, apart from the demand to subside and supply, hopefully somewhere down the line picking up a little bit, we need geopolitical stability. Obviously, the talks of war and some sort of invasions and all of those things creating instability is not helpful. And I would regard that as a very important factor. Whole US-Iraqi story, and even now in Western Europe and Eastern Europe and so on. Hopefully we can see some improvement along that line. And then, the slower global economic growth should culminate in a slower growth in demand for commodities. But then obviously, key commodity consumers like China, India, are still growing at rates, between 7 and 10%. So, it doesn't look like there's going to be a leg off very soon from that avenue. But generally speaking, it looks like we're more in a sort of phase of equilibrium in terms of demand and supply, which should help a little bit bring down commodity prices.
Any thoughts on commodity prices in general, or oil in particular?
I think Iman has covered it very well. It's mostly been a demand, and there's definitely been a speculative element to that as well. The markets have always guessed, how big is that speculative component. And I think some of that has been reduced, and that's why we've seen the price come down. But a big impact also has been from slower global demand growth. It's starting to come through. You also remember, although it's a demand story, it's also been a supply story from a capacity problem. There's a lot of capacity problems in refineries, particularly in the US, because of underspending in terms of investment over the years, pretty much like we experienced with ESCOM, and you don't change that in 6 months' time or so, it takes years. So eventually, I think that will start to filter through as well. But clearly, I think with the slowdown in global growth, it probably came from a commodity price, and particularly the energy point of view, probably came at a very good time. Help to reduce those prices. I think it'll certainly help, because food prices to a large extent will be driven by high energy prices as well. And I think there is definitely a move more towards energy alternatives. It's been spoken about for a number of, as long as I can remember. Suddenly there's a bigger drive towards creating energy alternatives. And I think that will over time also have an impact. Clearly, as Johan said, the geopolitical scenario, which unfortunately I don't think, once you've sorted out one problem in one part of the world, another one emerges somewhere else. Even in Africa, in terms of Nigeria, their problems in the Delta, has a huge effect on the oil price as well. And I don't think that's going to move out of the equation pretty soon. So there will always be that element, the geopolitical element in the price. But I agree, I think we've, the likelihood of moving towards $200 a barrel, which as we've spoken of not too long ago, versus $100 is probably more likely we're going to move towards the $100 level. But I agree that we're talking about $30, $40 per barrel. I can remember 10. In my time.
You got it.
Can I just add, there's no Obama last night apparently made a lot of promises if he were to be elected. When he would deliver in 10 years' time a sort of a reversal of the dependence of the US on Middle East oil. I'm not sure what he sees in the supply side, but it's an indication of what he thinks is possible.
But there's been a drive towards that for quite some time already. I don't have the exact numbers in terms of what Africa in particular provides. I mean, Angola is the biggest exporter of oil to China, for instance. So it's not just the US that's moving away from that. It's because of the instability in the Middle East. So the East is doing exactly the same. And that percentages are going to grow over time.
Well, I suppose with these prices, there's an incentive to do something else, to pull your oil with alternatives.
Sorry, one concern obviously is referred to the alternatives. You know, the utilization of food products for purposes of biofuels and so on, and the spillover of the oil problem into the food arena. A phenomenon I've sort of coined bioflation. You know, that is a concern. You know, and for instance, in the US, I've talked a little bit on the correction to be corrected, it's done a little bit to be corrected, but I believe about the equivalent of the annual US maize or corn production, as I call it, is being used for biofuels purposes. And obviously we've seen the repercussions thereof into food prices globally. And you know, it creates an additional problem for us. And I'm not sure how we're going to correct it, but it is a big risk.
We should perhaps just quickly move over geographically to the emerging economies, China, India. 10% average economic growth in China, aiming for 8% in India. Is that sustainable, do you think? What are the constraints there? China, India, would you like to start that one?
Well, firstly, you know, looking at China, I think one should be a little bit cautious on the numbers. You know, well, let me put it this way: people who are closer to that area, you know, of the world in terms of analysis sort of suggest that the growth might have even been higher than what the official numbers suggest. So that is one factor to take into consideration. Secondly, look, when there's a global moderation in demand, particularly on the export side, China will feel the impact of that. And the US, for instance, is a big export market for China. And they're probably bound to experience some moderation in growth. Likewise in the case of India, or India as the two are called together. But, you know, growth rates between 7 and 10%, those are still, you know, we can do with that any day.
Not too sure.
Yeah, for sure.
Hello.
Once again, I can't disagree with you, I also think the numbers are probably undercalculated. I think the same goes for many, particularly South Africa as well. Definitely in moderation, we're already seeing it, not as significant as in the US and in Europe, for instance, but moving from about 11% to 9% thereabout in China in particular. So a 2% drop, I mean, we dropped 2%, it's quite significant. That sort of level, it's not that dramatic. And also I think for a long time, last year or the year before, you know, the debate was about the Chinese economy overheating. So again, I think the global slowdown comes at a very good time for them. It's sort of a natural slowdown to avert the economy overheating. And I think the same goes for the rest of the emerging world as well.
It has been said that one of China's most important recent export items has been disinflation. Inflation has seemed to be moving up. Is that the changing imbalances?
That is changing, certainly, both India and China in terms of providing disinflation over the world. So there's no commodity price, manufacturing price in particular, that certainly seems changing. The wage rates are increasing. I think that's an important part of the international. That sort of substantial contribution to low prices is something on the price.
Okay. Before we talk about South Africa, perhaps just a few general thoughts on Africa. We
Most certainly. We recently looked at, whether Africa, with the whole food security issue, whether, Africa is going to take advantage of the position of high commodity prices. And it seems that in quite a number of countries, governments are changing policies or implementing policies, might only be in short term of nature, because some of the policies such as subsidies and so forth, you don't necessarily want to implement over a long period of time, but to help food security and to take advantage of high resource prices. Ironically, South Africa doesn't feature on that front, unfortunately, but we definitely see a move in terms of trying to increase, especially from the agricultural side, to take advantage of that. Obviously, there's a lot of countries, the exporting countries, that are benefiting hugely from high oil price, even at current levels. And it seems with the changes that we've seen in governments over the continent, that they are managing those windfalls a lot better than they did a decade ago. So there is a clear pattern of improvement in terms of taking advantage and using what they're benefiting from in a correct way. Unfortunately, it does take time for those benefits to filter through to the people on the ground, so poverty levels are still exceptionally high, but it's not something that's solved for a period of time.
Then you seem to have something you want to refer to there.
Just the numbers of the IMF, the July updated IMF forecast for sub-Saharan Africa, 7.2% growth last year, expect for this year 6.6, 6.8 for next year. And this is what South Africa is aspiring to. The South African situation has changed now very substantially, and the fact that the army is making it sustainable. It wasn't expected 10 years ago.
No. And those handsome growth rates primarily due to commodities, I would imagine.
It's a very important story. Yeah.
You want any thoughts on Africa?
We
generalize the territory.
Yeah, look, I think one of the important issues once again is to make the transition from solving our differences over the battle of a gun to the battlefield. And I think just north of our borders, that's hopefully that will be resolved. But I think that general principle is very important, and it looks like we're making some headway in that direction. And no economy can sort of grow on a sustained basis if you don't have political stability. And I think that's a major challenge, and hopefully, the trend of improvement will continue.
Sorry, if I can just add, in terms of Africa benefiting from high commodity prices, on the other end of the scale, it's also probably the worst affected by high food prices and on the inflation front, and it's largely because food as a weighting in the inflation basket is exceptionally high. It varies from about 6%, South Africa is about 26%, I'm not sure how it's going to change from next year on, but like in Nigeria's case, it's something like 69%. So most of the countries on the continent is in the upper end of the 25% and upwards. So food makes a huge contribution to inflation. So on the one hand, it's benefiting a lot, but on the other hand, it needs to deal with this.
Okay, I think we're going to move on to the domestic economy. Just before we do that, I would like to point out that towards the end we'll give opportunities for questions. So if you'd like to keep your questions in mind, please. I'll give you a second. Keep your questions in mind. Then in a few minutes' time you'll have your chance to ask them. Sorry.
Ons mis baie by die dames sê agter dit aan mikrofoons af.
Okay. It is on. Let's give it a minute. Sorry. Right, we'll make it that. We'll sort that. Let's talk about South Africa. As I said earlier, 18 months ago, things were looking fairly healthy. We were celebrating yet another year of economic growth in the region of 5%. We're talking about how many months of economic upswing, the longest economic upswing ever recorded. But things have turned a bit pear-shaped. Along with those improvements, we saw the current account, the balance of payments getting bigger and bigger, the deficit getting bigger and bigger, approaching, I think, around about 90%. But we weren't too worried about that either, because foreign capital inflows were in the vicinity of, probably around about 100 billion rand or more per year. And yet, in that there is a vulnerability. We've been saying for years that South Africa's balance of payments is often its Achilles heel. So let's talk about that first of all. Ben, current account deficits, financial inflows. Is it comfortable? Should we be worried? Are the reserves under pressure, under threat? Where do we stand now with all of that?
First of all, that's a big topic.
Yes. That's a big answer.
Well, that's a sort of a hard, clear answer. This is not easy. We've had, over the past 4 years, we've had 560 billion range of foreign capital inflows, about 8% of GDP. It's quite new to us to experience that. We last saw something like that in the 1950s, and then all went into resources. We've used a lot of that. We did save some of that in the form of reserves. Reserves increased from 8 billion to the current 34 billion. So we did save some of that, but our pattern has been quite different. In Asia in particular, most other parts of the world have been running on surpluses. So we do stick out internationally. And the question is, if we want to continue running sort of a strong investment program, getting investment up to 35% of GDP from the current 21.5%, how are we going to finance that? Are we going to continue to rely on the rest of the world? Currently, they finance, as Andres indicated, 9% in the first quarter through current account deficit. So it's probably the biggest macroeconomic risk that we are running. The risk of a sudden drying up of capital inflows. A lot of the capital inflows have been into the equity market. The first quarter that is actually a negative number. I think for the year up to date, we haven't seen a positive inflow on that score, so we must have been getting some other capital flows, bank borrowing, etc. So I think that's a real question to the policymakers, and also in the sense of the broader economic, the macro balances in South Africa. Can we continue to run a deficit? The BR's forecast is like between 6 and 7% over the next 5 years. We saw the IMF a little while ago in South Africa. They were talking about 7 to 8%. And I told them, well, it's not sustainable. So, well, we know, but we don't know when the thing will break. And it's a big topic in terms of whether you can run a deficit. Australia's been running a deficit of 4.5% since 1980, but they're quite exceptional. Deficits of the order of 7% and higher has been experienced over the last 40 years by about 25% of countries. So it's not strange to have a deficit of the nature, but it seems unlikely that the world will continue to provide foreign capital to South Africa to the extent that they have over the last 4 years. So the question really comes to the fore. Is the current account sustainable? It's probably not really sustainable at the levels where we are. What can the government do about that? They're probably not going to do anything really. Wait until it happens and see what the play out of that would be. But let me stop there.
Well, actually, to pursue that thought, if it does happen, if for some reason those inflows slow down, I would say dry up, what does the government do? What can the government do? What do they need to do? Whether you want to take that Ben or Malani or
Well, I'll take it. Let them first.
No, well, let me first say, obviously it's all a relative game. Capital chases profit. So that's the first challenge, I think, if you talk about the role of government, is to make sure that we create a profitable environment for investment that will attract investment. And obviously then, there's a host of things the government can do in that regard. To start off is to create the correct enabling environment for business to thrive. For that you need law and order and all of the other stuff. I think that's important. The preconditions for economic growth should be put in place. If it dries up, then it becomes tough, because then obviously your currency will reflect that. The risk for significant currency deterioration will be on the table there. And then it's a challenge as to how you handle that. So we try to put in limits, which is not desirable. it will be a difficult path. There's a lot of things you can do, but whether it will result in the desired outcome is a different story. It will depend on where you find yourself in the cycle, what's happening elsewhere in the world, where interest rates are on a relative basis, etc.
Would you like that to do it?
I think you uncovered it well, and it most certainly will have an exchange rate and interest rate effect, and especially if it were to happen in the short to medium term, given the state of our business cycle at present, our level of economic growth where we are at the moment, it would be a lot more difficult to get out of that position than we would have been just 2 years ago. But, capital flows have always been, as long as I can remember, it's been part of the debate, that we're too reliant on portfolio flows. But somehow we've always managed. But I think there is, the risk is most certainly becoming higher, that it could potentially dry up, particularly on the portfolio side. I think thank goodness for the infrastructure investment that we are seeing, because a lot of, I think, that is related to the foreign direct investment that we are seeing. And then I think that's moving into a whole discussion in itself is what happens next year with the changes in the top structure of the ANC, and what is the likely impact on economic policy, and what would the impact of that be on enabling the economic environment that you're referred to. So there's a lot of uncertainties at the moment, but certainly the risk today is a lot higher than it was, again, a number of years ago.
Right. I fully agree with what's been said now. If I was to talk to first-year students like we do, then tell them what it seems simple with the problem. We're sitting with probably for this year, current account deficit of 160 billion rand. So of that order, it's about 7% of GDP. So it's slowing down from the 9% for the year. So if capital dries up, we've got about $34 billion worth of reserves. We can use some of that. But there's likely to be, you need to have an adjustment. Either your imports cut back through domestic demand suppression, or your exports improve through some currency reactions. And essentially you have a choice, or a mixture likely. Initially the currency is likely to react because we've got a very well developed foreign currency market, and then interest rates need to follow. And the question is, what's the mix? Are we talking about 3 percentage points increase in interest rates from where we are now? As Lonnie said, it's difficult. The currency is likely to react. Our forecast of the currency is, get to that I guess, about 8 Rand by the end of the year, 8.50 by the end of next year. It's likely to be substantially different under a sort of a situation like that. But it needs to be, you need to rebalance the economy, domestic demand has to slow down, to get a reversal on the current account. That's required. It's not a decision I think that the monetary policy authorities will take as we stand here. They will react to whatever happens, when it happens, but I think the currency market is going to take the brunt of the impact under a circumstance like that. And it shouldn't necessarily be long-term, but a short, sharp reaction.
Well, I think we've already started to talk about some of the really important issues, at least as far as business people and consumers are concerned. All these talks, all these stories translate almost into questions regarding implications for inflation, interest rates, the exchange rate. Let's talk about a few of these things. Inflation, the latest figure, 13%. Many questions arise from that, such as, well, I think we all know why the inflation rate is so high, but questions such as, can it go any higher? How high is high? Have we reached the top? And then, of course, the concomitant implication for interest rates. Let's talk about those two first of all, inflation, interest rates, the interaction between the two. Are we at a structural level of inflation? Is the 3 to 6% target too ambitious? Where are we in terms of interest rates, inflation rates, Johan?
Well, the 13% I think may be the peak of the cycle. However, our base case forecast suggests it's only going to be the number for August, which we're going to receive in September, where we forecast that at 13.1%. But admittedly, at the turning point, it could come a month later or so. The important thing, however, from a monetary policy point of view is what's going to happen 12 to 24 months down the line. And in that regard, we're all aware of the fact that we're going to implement the new CPI X basket from the beginning of next year. And there is going to be a structural adjustment as a result of that.
Downward one.
Yes, downward one. Quite significant, or at least 1.5 percentage points in terms of our estimate. So our forecast suggests that by late next year, and obviously we're making the assumption that key inflation drivers like the oil price and the non-exchange rate will behave, for a change, we hope. But on those sort of assumptions, so we forecast CPIX to be in the vicinity of the upper limit of the target range by the end of next year already. So if you then look forward, 12 to 24 months forward, over that policy horizon, we sort of, at the top of the target range. And in our view then, given that scenario, in the first instance, from an inflation targeting point of view only or purely, there's no need for further tightening.
Of monetary policy.
Of monetary policy. In fact, given that forward-looking approach, the window to start cutting rates is sort of going to start opening soon, if not open already. Having said that, I don't expect rates to come down, within the next month or so. In fact, our forecast suggests the bank will probably err on the cautious side, and probably somewhere by the second quarter of next year, we could see rates coming off with the risk in the near term rather than beyond that.
Okay, thank you. Fairly bullish.
I think this has probably been, for me at least, the most difficult year to forecast inflation. With all the variables, or unknown variables that we had to deal with. First the commodity prices, and then the electricity tariff, and how much it's going to be, and every month you've got to do a forecast, and you've got to slot in some kind of a number, and finally when we got that a month later, Stats SA came with the adjustments in the basket. So I think it will be interesting, Professor Smith, what the Economist of the Year forecasts are going to look like this year compared to what actually is going to pan out at the end of the day. But I agree with Johan, our trend is pretty much the same. I'm not sure that we, at 13, I don't think we're quite at the peak, but we're very close to it. And that thank goodness for the changes in the basket that is going to come, because it would have made, I think the impact on the economy with the level of interest rates, it would have remained at these high levels for a lot longer, was it not for that. And I agree, our forecast also suggests that we probably would move towards the 6% upper end towards the end of next year. I'm a bit more uncertain in terms of when we could see an easing in monetary policy, because how's the Reserve Bank going to look at it? Do they just going to want to see a substantial or sustainable downtrend and then act on it? How far away do you need to be from the upper end before they start doing that? And I think also they're going to look back at history and going to have that cautious approach. Given what has happened with credit levels, I also don't think once we've moved into the downward cycle, the bottom of the cycle is probably going to be a little bit higher than the previous one, given the impact that we've seen on credit levels and the way South African consumers tend to spend on credit. To make sure that they don't run into the same problem. In hindsight, it's always easy to look back, but we probably had 50 or 100 basis points, maybe even more, of too much easing in the previous cycle. And I think they would be very cautious not to run into the same problem this time around.
Well, it seems that the ER's forecast has been reading the same tea leaves as Johan and the line. Just some particular numbers. Our forecast suggests a CPIX 12% by the end of December, or by December dropping to about 9% by January, which is combined impact of oil, petrol prices, and also the adjustment in the rate. Also getting by about 6, just below 6 by the end of the year. But as you know, they're likely to change the target, so we should be looking at CPI. So our average for next year is likely to be 7.2 on CPI, but CPI about 7.5, which is pretty good. And that will probably only get to the target level somewhere in the first half of 2010. But these are all sort of very particular numbers. As the new numbers come out, we change it. I think the broad important point is that it certainly looks like inflation is at a peak or going to peak. That the interest rates are unlikely to increase from current levels, which reached the peak. question is, will it start declining by the middle of next year, or perhaps earlier? We're sort of choosing for the middle of next year, close to what the country is saying. The apple cart could be upset. I think partly because we're looking at all these particular components of the CPIX and forecasting that and getting to these very particular numbers. It may be that the impact of wage growth surprises us going forward on inflation in general. That, in other words, that there may be a risk to the upside. It may be that if things go wrong, we talked about the balance of payments, that the authorities get forced into quite a different scenario from where we are now. But Johannes said, and Lani both described, I think, what the economists in general would forecast now. Slow down quite substantially, and with a clear impact on monetary policy going forward.
And what you alluded to, and it was interesting to hear what Johan and Ben's opinion is about that, is whether we've seen a structural change in inflation as well. In the early 90s, with the economy opening up and import tariffs coming down and so forth, we saw a structural downwards adjustment in inflation. With higher commodity prices, although lower than the peak levels, but certainly at structurally higher levels than what we've been used to. Same on the food side, we're going to see significant increases still in electricity tariffs for a number of years. What does that say about now seeing a structural adjustment in inflation slightly upwards? Previously we were aiming to get to, say, 4.5%, the midpoint of the range. Is a 6% not more an average now going forward? And I think that then comes to the whole debate about whether the target range as such needs to be changed to reflect those structural changes.
Anyone would like to respond to that?
Target story.
The targets, the structural change.
Certainly the point that the line makes in terms of strong upward pressures. We had, when you talk about conflict, and then the topic you often talk about the impact of cost pressures on inflation and interest rates. Certainly there's risk with the electricity prices to double over the next number of years. Also broadly speaking, pressures from a variety of various commodity prices not likely to decline in the longer term or the short term. So we certainly are. You have to be, in a sense, optimistic to say, look, we're going to get back into target. We're going to remain, say, between 5.5 and 6 or 5. We feel okay to make that statement. I remember in 2001, when we were new to the targeting experience, and the exchange rate depreciated, remember, from 7.60 at the beginning of the year to like 13 rand, 80 at the end of the year. And the economists were making forecasts saying, look, we may just get to 6% or not. We said, look, we run the models, it's a 4-5% increase in inflation that's on the cards. But even ourselves, we weren't prepared to take that strong view this would happen. Of course, inflation blew out. I mean, the CPI went to 11.5, the PPI to 14.5 at the time. So it may be that we're, in a sense, constrained. We're not prepared to make big, bold statements. And Ulani has been known to be quite focused on inflation and the possibilities there. So I take your views seriously. But the general view is the one that we describing here. But there certainly are risks. If there are risks on the upside, the inflation will be higher. And then it's a question, what should they do to the target? My view is that if you increase the target, all that's going to happen is inflation expectations are going to increase. The real rates of interest rates are going to remain the same, so the normal rates are simply going to adjust upwards. You're not going to gain. I think that's a view among circles in South Africa. It says if we could only increase the target, then there will be less pressure on the central bank, and then we can actually promote growth. Well, I think that's a short window, like 6 months to a year, and then we're going to be right back up with inflation expectations simply reflecting that increase in the target. So it's a valid question to consider.
Well, let's try and translate all of this into our current business cycle. Growth slowed down, obviously. Now the question is, how low is low? How low could growth go? Are we at the bottom? Is the worst to come? How long will the slowdown last? Will the R word, recession, ever drop up? Where do we stand in terms of our local business cycle, John?
Well,
Yes, let me first say, we experienced the longest ever upswing, since September of 99, and by June it was 106 consecutive months of economic upswing, which is a record for us. My view is that was probably more or less the peak of the cycle, and difficult to tell exactly how the bank is going to define a period of contraction or say slower growth or this growth cycle having ended. But my view is that at the part of this year we sort of going to start, or say the end of that upswing probably ended around about the middle of the year. Having said that, I don't expect a recession. Even if you look at this year's forecast, growth numbers quarter-on-quarter is even just annualized around about 3% and 2% for the last 2 quarters. You still get an annual growth rate of 3.7% roughly. And then next year, which I incidentally believe is going to be the weak year because of the lags, my forecast suggests growth still around about 3% real. No trend smash. In particular, if you look back at our historical performance, 3% is sort of peak growth levels rather than bottom of the cycle growth levels. And then, by the latter half of next year, the cycle could actually start improving again, depending on when we get the first rate cut. So, in my view, we enter a cyclical moderation, but no recession. And I think, generally speaking, business conditions will still remain fairly good. Obviously, on the consumer side, there's a lot of pain currently. But fortunately, we've got on the fixed investment side the underpin of government's fixed investment program, which I think is going to be material over the next year or so. And that's not necessarily interest rate sensitive nor cyclical. And we're looking for between 500 and 600 billion on a rolling 3-year basis to be spent by government on fixed investment. And we're going to see that underpinning factor helping us to prevent the recession. But a lot of things can still go wrong. But generally speaking, I'm fairly optimistic. There's a bit of pain ahead. But by the end of next year, early 2010, we should be on the up of the cycle again.
I agree with you, Anne, that in 2009 I think it's going to be the weak year. It's going to be slower growth than this year. We're also looking at forecasts of around 3.2 to 3.5% for this year, and then slightly lower for next year, and then rebound coming in 2010, bar any major upsets globally, of course. I think in terms of the infrastructure investment, that's been our saving grace. If it wasn't for that, and that's mainly driven by the World Cup in 2010, then certainly I think a recession would have been on the cards for us, because that's what's driving our growth at present. We've seen a significant slowdown, and a lot of that yet to come on the demand side. And that's been what's been mainly driving our growth over the last few years, is that it's been demand driven, not so much from the supply side, and very little from the fixed investment side. So thank goodness for that. And I think once the interest rate cycle has changed, and that's why in 2010 we should see a bigger rebound, hopefully by then the demand side would have picked up again going forward. But certainly, I think, as Johanna said, we basically just back to our previous potential that we've managed. Unfortunately, we weren't able, but global conditions to a large extent have dictated that we could not remain at 5%. Another debate, all in itself again is, what should be our potential? We've always spoken about 6 and,
The growth outlook, the short-term growth outlook.
Most quite fair that the choice of speakers is really given the same volatility. I think that I fully agree with the baseline case. We've had sort of more than 100 months of upswing. The previous upswings have been kind of the longest upswing we had in like 44 months. So this is a real new experience. Growth at such a high rate for so long, particularly since 2004. And it's been mostly demand driven, as Milan has indicated. The Harvard group that advised the National Treasury, when they came here 2 years ago, they looked at the situation and said, well, it's not sustainable. £5 billion of payments, which is wasn't that bad at the time. And so you need to have a rebalancing. If you want to grow your investment at the rate that's intended by government and otherwise, you need to have the resources in the economy that you can use to provide that investment. So you need to have some slowdown on the private consumption expenditure side. And so in a sense, what we are experiencing now was, from a broader perspective, really required. We couldn't continue the way we are running private consumption expenditure 7% plus. It was certainly not sustainable. Also, if you've had sort of like, what is now, what, 2 years, so we're talking about 7 years of growth, it's very much sort of stagnant to have some sort of a slowdown. It's just, I think the impact in January was a shock. We expected to see some people slow down. The VR's confidence indicators sort of showed that, and then the electricity problem sort of really was a wake-up call in a variety of respects. So it may well be when the Reserve Bank in a year's time tell us where the cycle turns, that it may be in January or December or June as indicated. So the baseline story, I think I fully agree with. We are looking at a slowdown from 5% growth to about 3%. But I think one should also realize that the pain is there's still more pain to come. We are not through this process. We're not right at the bottom. I would also agree sort of late this year, early next year. But there is also a possibility that we move into an outright recession. We find it being 2 quarters of negative economic growth, 2 quarters of decline on GDP. We don't expect to see that in the VR. I personally sort of definitely don't expect it, but there is a possibility that can come through. It could be sort of international developments in the first place that could trigger something like that. Or simply sort of our lack of understanding as to the impact of the credit-driven sort of processes that we've seen in South Africa too, and the unwinding of that sort of going forward. We saw some positive numbers in the second quarter, 4.9% growth. It's unlikely to be repeated. The growth for the second half may even be lower than the honest indicator. We could have, for the next 12 months from where we are now, we could have growth that says as low as 2%, fairly easily. But the 3% story that seems like what most economists would agree to. If there's a risk, it's on the downside, I think, not on the upside.
To what extent do you, or should you, build in the possible change in, let's call it, policy, given the changing of the guard next year at political level? Should we be concerned about the role of the Reserve Bank, etc., the way they're dealt with? We need to build in a bit of political noise into these scenarios. Is that built in? Should we? Are we worried about that?
I don't know if tell who's going to be the next president.
Well, to answer your question directly, I'm not personally too worried about that. If anything, if you look at the growth prospects over the next 12, say 24 months, it looks like if we are going to see a little bit of a change in approach, it might be towards a more lenient approach, which obviously in the long run is not necessarily good news, but in the short run we might end up with a little bit higher growth than we anticipate at this stage. But having said that, I think back towards the early 90s, around about the period of time of transition. And, having been involved in the markets, I think back how the markets reacted when Mr. Manuel was appointed as Minister of Finance. And so, the bears being out there and selling the market down, etc., etc. And looking back, in my limited experience, Mr. Manuel is probably the best Minister of Finance we had thus far. And, Mr. Winning not far behind it. So, I tend to be an optimist, and I think when these people are put in responsible positions, they do the right thing, or they tend to do the right thing. We shouldn't forget we're part of a global village, and those pressures will dictate to a large extent in terms of what you can and what you can't do. And, so political change is part of life, and I don't expect significant deviation from the current approach.
Our view is that, as Jan said, we don't expect any major changes. As he said, we're part of a global village, which would dictate to a large extent what they can and not do. I think the elections are going to come and go. Not much is going to change, although there's been definitely there's a more leftist, more social focus given the new leadership in the ANC. You're going to see small tinkering, which we might not even notice over time. What we are more concerned about is what is not going to change in terms of structural changes, labour laws, privatisation, etc. The things that the rating agencies have noted for a number of years, where you are, South Africa is not likely to get a higher investment rating, those issues, that's off the cards now. That's not going to be changed, and that's what we're going to concern about. In terms to get this economy to grow at the levels that we need to grow to address poverty, unemployment, all those things, that's not going to happen because those drivers aren't going to be there, because the policy is not going to be focused on that. So we're not that much concerned about what's going to change, it's what's not going to change.
Okay. Oh, I say a TD story. 2 years ago, if they told me Mr. Zuma would be the new president, I would have been much more concerned, and I think we and the business community seems to be now. We speak to political analysts, we don't try to forecast the problem ourselves, and the clear indication is that it will be, it's very likely to be Mr. Zuma in some way getting past him. All the stories we have to say. Or someone within the group, but very likely Mr. Zuma. So the question that concerns everyone is to what extent will he be beholden to the Communist Party of society to deliver on the promises or the promises of these sort of rises. To us, the assumption that we make when we do our forecast, longer-term forecast, is we will not see a big movement towards more populist economic policies, but that is a risk. The risk is it's going to be much more pressure for spending. We've had exceptionally good experience on the fiscal side. It's important that continues. Mr. Ben was trying his best to do that. But I think basically the most important factor to me is the one your Honor has mentioned, and that is the facts of life for the new government is going to be the same as the unemployment problems, in particular the need to maintain economic policies that are acceptable to foreign investors on these famous sort of issues. But there's likely to be more of an emphasis on social spending. We may also find sort of beneficial movements on BEE. There's been some commentary in the newspapers recently. I remember about 3 months ago, we were at a meeting of economists, and Liv Woods from UWC sort of said that that's one thing you would expect to see sort of a post-Mr. Mbeki government to be perhaps less focused on affirmative action, being a bit more realistic on issues like that. So for the moment, we're keeping our powder dry and say that politics is not going to derail economic policy changes coming from the political side, is not going to derail a reasonably good economic performance.
I think to start wrapping up and perhaps concluding, looking beyond the next 12 to 18 months, I think we're all still aware of many other problems, such as unemployment, such as poverty, that all of you have mentioned. We know that it has been suggested we need a growth rate of 6%, a sustained growth rate of 6%, and in terms of the ski slope, pretty soon, 2010 onwards. That might or might not be rather ambitious, but and we've also mentioned the country's long-term economic growth potential has traditionally been, 3.5%, 4%. What needs to happen, or what might prevent our economic growth path from moving to a 6% plus kind of trajectory? What are some of the constraints which we have to deal with? Medium, long-term structural constraints. What would keep you awake at night? Just the big story constraints. Let's start with Ben this time, maybe. So then better choose the others will lead into TVs.
It's always a difficult question to ask. We had the Harvard group, we had other groups here, we had vice government, people come up with different sort of views on it. Education is a big issue. It remains sort of one of the real vexing problems as to why it's been so difficult to improve on that since 1994. And it's crucially important, I think, for long-term performance of the economy to skills creation, education, generally speaking. We are really poor in terms of what the society is delivering for the kids. On the second one, just to do, sorry. No, go ahead.
I think I agree with Ben's skills. We all know the problem with the skills in South Africa. And then I think I've already alluded to it is the structural issues that still need to address and that's likely not to be addressed in terms of labour laws and privatisation, etc. just want to make a final point on the previous discussion in terms of the political side of things. I think it's irrelevant at this stage whether Zuma will be president or not. The fact of the matter is that the top 6 in the NEC, all have got a leftist, have got a military background compared to the current or the previous. And so it's regardless of who is the president, that's the main body, decision-making body within the ANC. So Zuma is irrelevant at this stage.
Okay. You want the structural stories?
Yes, I agree with what's been said. I can maybe just add two. One is, in order to grow, we need sufficient savings. Whether we use our own savings, which is fairly low, so we should do something about that, or alternatively use foreign savings by way of foreign investment coming into the country. That's the other alternative. So the combination of those two issues, I think, are rather important. And then on just generally speaking, the ability to produce competitively. In the end, we have to compete, whether we compete domestically against imports coming in, or whether we compete on the international markets, by exporting. We need to be competitive. And behind that, you can find a whole host of issues, labor, productivity, labor issues, the productivity of capital, all of those sort of things. But in a nutshell, they need to be competitive.
Well, thank you. I will give you a last word in a few minutes' time. But I wonder whether we have a few minutes for any possible questions from the audience. Anne-Marie, is she here? On the microphone? Otherwise, I'll walk around the microphone. Here's a question.
Thank you. I just wanted to ask the panel their opinion on South Africa has taken an approach to inflation targeting vis-a-vis China, who probably control the yen, so that they sustain the competitive markets that they're exporting, and their customers could have some stability in what you're paying. Now, South Africa's rand is going up and going down, and we've let the rand float while we control inflation. Do you think China's chosen the right model versus South Africa? Which is the right model, and is there any appetite to change that? Just trying to get your opinion on that.
Would you like to go one first?
Personally, I'd like to see perhaps obviously a more stable but a more competitive currency as a general sort of feature of the African economy. So I would certainly, if there were a way to have sort of more control over the currency, not a sort of fixed currency, but sort of have some way to maintain the rand from going back from the 6% like it did a couple of years ago. The problem, or the fact of the matter, is we've got an extremely well-developed foreign exchange market. The Reserve Bank is a small player in the market. The ability of the government to control the behavior of the currency is really, really limited. You can, broadly speaking, through maintaining good macro balances, but there's no way that I think South Africa can move to a more controlled foreign exchange arrangement. So we don't have the option. But I would have liked to have seen a situation where the currency could play a more stable and a more important role in guiding economic growth going forward. Whether China's taken the right route is difficult for me to respond to that. Certainly the Asian economies in general have maintained more undervalued currencies than we have. And we've certainly paid the cost for having such a strong currency over the last number of years. So I'd very much like to see something like that, but I don't think it's feasible.
Any more questions? I'll try to get. Could I ask you to perhaps just pass this microphone back up?
Thank you. I'd just like to ask panelists, in this scenario you've sketched of doom and gloom globally, recently there's been a revision of people who are poor classified as people who live just under $1.25 per day. How does that affect the poorest of the poor, who are faced with looming food insecurity, famine, and unemployment? And how should our government in particular be responding to that in business?
Would you like to hit that one? Doom and gloom scenario. I was actually quite pleased about your scenario.
Look, as far as the technical classification of what is poor and what not, I believe the benchmark has been moved from $1 a day to $1.25 a day. I would move to say that reality that didn't change reality. The mere fact that more people are sort of falling in being classified as poor now compared to yesterday, where the benchmark was a little bit different. In practice, doesn't change anything. However, having said that, obviously, it might have an impact on the attitude of donor countries and people wanting to help out. And certainly, as far as our domestic our country is concerned, government's approach to that would certainly probably be affected to the extent that the problem now suddenly would be perceived to be greater than what the perception was before the adjustment. And that might trigger additional sensitivity towards addressing these issues. To what extent that will actually happen in reality, it's difficult to tell. It will depend on government's attitude towards that. But generally speaking, I think what it does tell us that there's still a lot of challenges out there in the world, and many people are still suffering. And hopefully it will raise the sensitivity, generally speaking, to everybody to sort of try and do something about that. I don't know whether I've answered the question.
Yeah, I suppose part of the question is, which is difficult to answer, is does this justify food subsidies? Which is another totally, it's a topic of its own right, a huge topic. But let's take right and back the question, are you able to project your voice so we can all hear you?
Ek het net twee vrae. Afrikaans alright.
I'll translate on your behalf.
Ek het net twee vrae. Die een is, ek het verwag ons sou so 5 minute spandeer het op Eskom. Dis nou die broer wat nie tronk is, ons praat nie oor hom. Die eerste vraag is, gaan ons werklik die agterstand inhaal, wat ons 10 jaar agter is op hom, en as ons daai agterstand oor 10 jaar ingehaal het, wat in die volgende 10 jaar wat ons nou die groei moes ingebou het? Die tweede een wat ek wil graag wil weet is...
So, can we take that one first? Okay. The question is about Eskom, the backlog, the infrastructure backlog, are we going to catch up, have we caught up, and will we remain caught up, essentially? And is it such a big story?
I was doing a presentation to Transnet board yesterday morning in Paarl, and Mr. Alec Owen was sitting there. I didn't expect him. So I had this graph on the Eskom sort of the outlook for power electricity provision in South Africa. It says that over the next 5 years we're going to run sort of quite a risky operation given the spare capacity and all that. But after that, in a variety of ways, through Eskom itself and through if Eskom allows for that and government allows for that sort of participation from a variety of sort of other areas. So my short answer would be that I think things are going to remain quite tight for say the next 4 or 5 years. But afterwards, I wouldn't be so concerned about going forward. The other issue, we did some work for NERSA that suggested that the price elasticity of electricity is between 0.3 and 0.5. So if you double the price, you're likely to see quite a substantial sort of cutback in demand, generally speaking, not from the aluminum factory, but others. So one will have to see how the price increases sort of play out in contributing to a situation where there's less pressure on demand. Now, the Eskom has been a big story. A lot of talk, we were somewhat surprised to see sort of the extent of non-outages over the last couple of months. It appeared that perhaps it was more a coal problem and a management problem than it was an actual capacity problem. But we do believe that the capacity sort of issue is going to remain. So I'm not as concerned as your question indicates about the brother in jail. He's there, but it's okay.
Before we take your second question, maybe go back to somebody else who would like a turn. If you mind, I'm going to give somebody else a turn, and then we'll come back to you this time. Yes.
My question is totally different, seeing that US and European major partners, where do you see the euro, dollar moving to especially after the elections and stuff?
The American election.
I'm almost as proud of my euro-dollar forecast is my old topic. But look, I would imagine, generally speaking, interest rate differentials will be driving the euro-dollar exchange rate, and that's going to be the key issue. It looks like at this stage we've entered the phase of dollar strengthening vis-a-vis the major crosses. Currently trading at around about 147 to the euro. Our approach is almost the same as the ESCOM thing. On the currencies, we tend to rather not take big bets call it on the exchange rate movements on a forward going basis. We'd rather use the spots as a sort of reference point and then highlight the area of risk. And certainly, given current circumstances, that area of risk is for a stronger dollar rather than a weaker dollar against euro. So I'm afraid that's the best I can come up with at this stage. I generally speaking see the dollar strengthening over the course of the next year or two. But to give you a pinpoint forecast of a currency is an impossibility.
Central Bank?
Yes, we have got very particular numbers. I could call you 145 by the end of next year. But the broad trend, I think, is appreciation of the dollar over the next 5 years, say, to a normal level of 138, 3, 4 years down the line. Because of the circuit. But as you understand, that's, if you want a number, I give you a number.
Right. Any more questions before we go back in?
What short-term and what long-term effect is 2010 going to have on the South African economy?
Okay. I think part of the short-term, something I've answered, I think you mentioned that earlier in the answer of investment spending. So let's perhaps focus in a couple of seconds on the slightly long-term impact, if we can. Now, we'd like to pursue what you were saying earlier about short-term, let's translate into long-term.
Yes, I think, as I said, I think the infrastructure spending has been a saving grace at present and over the next, up until 2010 at least. As always, infrastructure investment, although it might be focused to a specific or particular event in this case, once the infrastructure is there, it can be used afterwards. And I'm not just talking about the stadiums, it's everything else that goes with that in terms of roads, etc. So we should see, I think Ben might be able to give better numbers because of their modelling of what the effect would be on economic growth going forward. But I mean, just from a perception side, it certainly has to have an impact going forward. We see that in Africa, which comes from an extremely low base. In terms of poor infrastructure, there you're seeing the, particularly from an FDI point of view, infrastructure investment, it immediately translates into economic growth on a more sustainable basis going forward. So we should continue to see the benefits of that beyond 2010.
Right. I'm afraid we're actually running out of time. Maybe if you just chance, you can have a quick word afterwards. I would like to give each of our panelists a very quick final word, whilst reminding you that, looking at the time, there are three kinds of economists, those who can count and those who cannot. Just a very quick word in half a sentence. What words of comfort or discomfort would you like to leave with the business audience?
I hope I'm in the category of being able to count, but look, I think generally speaking, we should acknowledge that economics or business cycles are there and will be part of life. We're currently experiencing a downturn phase, but I think what we shouldn't lose sight of is the fact that we're still growing at 3% plus. And that still is a major achievement in the South African context compared to where we're coming from. And looking forward, the prospects are looking quite rosy on a comparative basis. So I urge you not to be too negative or too despondent and sort of realize that this is a cyclical event and there are better days ahead. And in the end, it depends on all of us as to what the magnitude of that improvement is going to be. So let's remain positive and do what we do best each of us.
Thank you. Lani.
I also like to see myself as an optimist, but I'm also a realist. And I think a very good way, if I take the title of this discussion, Bloom or Bloom, I can maybe compare it to the current weather that we're experiencing. Just as you think spring is finally here, we experienced the last 2 days. And I think that's pretty much what we, over the near to short term, will experience in the economy and the financial markets in particular. A lot of volatility, it's the nature of our financial markets. And, but in the medium to longer term, you know, it'll definitely bloom. As Jan said, you know, we've created a much stronger base over the last 6-7 years than what history suggests. And we can only build on that going forward. And I like to think, despite all the uncertainties, that we will get past them, we will deal with them in time, and then ultimately this is a prosperous economy in the country.
Thank you, Ben.
Well, I was going to say you answered it all, and Lani, which you actually did. We've had a very good run, and what we're experiencing now is a normal reaction to that, getting a bit tired. We're a small business person servicing the retail sector, perhaps not as easy to say it like that. But I remain concerned about whether we really are going to put it together for the 6%, not the 6%, we're not easily going to reach that. But do we have the wherewithal in terms of government, of the private sector, of South Africans in general to deliver on the sort of needs that society has? There's so many obstacles that seem difficult to overcome. So we are forecasting like 4.5% growth from 2010 onwards. So 4.1 average for the next, we want a 30-point number for the next 5 years. And it's not guaranteed that we will actually sort of get back there. The baseline view is, as both Jan and Melanie has presented, I agree with that. But I do remain concerned that we may not be putting everything together as easily as a lot of other emerging market economies do. I'm not sure that our eyes is sufficiently on the ball. I don't want to talk about sports. Not in South Africa right now. Let's stop it.
Thank you very much. I'm sure you'll agree that we could have gone on for hours and really probed into all kinds of things, but on the other hand, in the space of 1.5 hours, I think we've come to grips with a very important structural and cyclical realities in the economy. I think I personally welcome the fact that we have a degree of cautious optimism. Things have been worse. They could get better. They could be better. They will hopefully get better. But things have been worse. I remember speaking to someone the other day who said if economic growth this year is only going to be 3%, well, bring it on. If that's the worst it gets, please. I welcome that. But I think we've also, very importantly, that it would be fatal to rest on our laurels. There's still a great deal of work to be done. On that note, I would like to thank not only the Business School for sponsoring this and hosting this as always, and the other sponsors. Thank you very much for that. Thank you for your attendance on a Friday morning. Have a safe journey back. And then a special word of thanks to our 3 panelists. A small token of our appreciation on behalf of everybody. If I may quickly hand it over to you. Thank you very much. And while I'm doing this, I will probably add that this has probably been an extremely difficult situation for the 3 panelists here. I'm not really knowing what to expect from questions, how the questions and answers would evolve, and I really do admire you for that, and thank you very much for that. Thank you very much again.